Well, good morning again, and thank you for joining us this morning on our weekly webinar for life insurance. Mark Hunter here with Messer Financial Group. Once again this morning, we're going to present information from another one of our carriers that we are contracted with, allowing you as a producer to find some of the sweet spots and know how you can additionally help your clients with confidence. Just a couple of housekeeping issues. Number one, we do have the phones muted, but always, just in case, if you'll personally mute your own phone so that we don't have any backup static coming through. We're going to ask that you go ahead and type your questions in on the box on the screen to the right, and that will enable us, when we complete the presentation this morning, to come back and address those questions. Also, we're going to ask that you stay online with us until the very end, so that those of you who are with us today, who are registered and on this web, will be eligible for a bonus incentive that will be placed on these particular products. And with all that in mind, it's my pleasure this morning to bring to you Justin Shima with the MinnesotaLife Group, coming to us this morning from his home office in St. Paul, Minnesota. Good morning, Justin.
Good morning, Mark. Thanks for the warm intro this morning. I wanted to apologize in advance for the phone beeping. I dialed out and we're on a recorded line and can't get away from the phone beeping, so it's just going to be there. But I wanted to, again, introduce myself. My name is Justin Shima. I'm a life product coordinator here at the MinnesotaLife Case Design Team here in downtown St. Paul. I appreciate the opportunity this morning to speak with the Messer Financial Group, and really what we're going to be talking about this morning is what we call a $99 legacy. Leave a legacy options for all families. So it's really a way for mom, dad, grandparents, show them how spending just $99 a month funding a juvenile policy and getting started early, and really what that can mean for the future of that child or grandchild. It can really help set up the children for a good financial start moving into the future. And so we're going to go through a number of different things here. At the end, I'm going to walk through kind of an illustration, really show the power of compound interest when you have someone as young as a juvenile. My example is going to be a 1-year-old. And really, to some extent, kind of let the illustration speak for itself, because it can be really, really powerful. And I think we'll take questions at the end, like Mark said. So I'll move on. We have 17 slides, so it shouldn't take all that long. Move on to the next slide here. So I'm going to kind of go over really what the opportunity is, providing a juvenile insurability. If you get them started with life insurance early on in their life, they can really get a foot in the door and lock in that insurability. There's a lot of value to that. Affordability, $99 a month. We're going to show how a little bit of premium can go a really long ways when you have the kind of time horizon that a juvenile, a child, or a grandchild has. And at the end, like I said, we're going to walk through kind of a case study and really go through a number of slides with some illustration, kind of show really the power of the compound interest. So protection to grow into. When you have a child, time is really on their side. You're going to really see, like I said, I'm going to keep coming back to the power of compound interest. Einstein said that compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. So there's going to be, given that time horizon, there's the time on their side for saving for college, house, emergencies, really anything they would like to in the future. A lot of policies offer paid up options where you can pay for 10, 20 years, and it's guaranteed paid up, so you have that peace of mind. Like I said, future insurability. So, it's really next to almost no underwriting for a juvenile. Just look at some medical records, but it's pretty straightforward that way. So they can get their foot in the door and lock in their insurability. And then oftentimes what people do on juvenile policies is add what's called a guaranteed insurability option. So how our guaranteed insurability option is it allows that juvenile, that child, once they reach the age of 22, to increase the face amount, the death benefit, of their life insurance policy $100,000 starting at age 22 and every 3 years thereafter without going through underwriting, so they can raise the net amount at risk to the life insurance company and get a higher death benefit without going through additional underwriting. And again, it starts at how ours works is starting at age 22 and every 3 years thereafter, 22, 25, 28, and so forth, up to age 40, they can raise their death benefit $100,000. So that's 7 potential times they can raise it. At $700,000 they can raise their death benefit without going through underwriting. And they can also forego one of those 3-year increments for a major life event, such as having kids or getting married. Then you can raise the death benefit at that point as well. And a bit of a differentiator that we have with our guaranteed insurability option is we'll actually let you go up to $100,000 increases. A lot of our competitors, they're around the lines of $50,000 or $75,000 increases. So we'll let you go up to $100,000. So flexibility, optional agreements. One of the most common ones we see people add is the waiver of premium. Once the child becomes of age and they kind of take over the policy for themselves, once they're no longer a dependent, if you add the waiver of premium, they get disabled. MinnesotaLife will pay the premiums on that policy in the event of their disability. So that's a great peace of mind to really make sure you kind of self-actualize that life insurance policy if they decide to keep paying premiums once they become of age. And peace of mind. Again, get your foot in the door with that insurability, and you can really have lasting financial protection that cannot be outgrown. Gift of a lifetime. So I think maybe what I started talking about is by finding a life insurance policy early on, you can really provide your children and grandchildren with a gift of a lifetime. And really what I mean by that is, as opposed to giving them a lump sum of money, say $10,000 or something, if you fund a life insurance policy, you're giving them locked in insurability and future cash value for all kinds of different purposes throughout their life. Everything from paying for college expenses to down payment on a house, any type of emergencies, supplemental retirement income. So, it really provides that gift of a lifetime. And you can do it under the annual gift tax exclusion with this $14,000 for 2016. So, most parents and grandparents aren't funding their policies more than $14,000. So you really don't have any type of gift tax consequences in that event. And really providing, that child with a lifetime of protection with somewhat unlimited financial flexibility. You can use the cash value policy for really any types of needs that you have, and that you have that tax-free death benefit, really protection that extends for life. And you have, of course, the tax-preferred growth in withdrawals and loans afforded by life insurance. Let's go like this here. Okay, college funding. So, fortunately, there's lots of different types of vehicles out there to save for college. Anything from 529 plans, I'm sure people are familiar with, Coverdell education savings accounts, Roth IRAs, and of course, life insurance. And the statistic here says nearly 2/3 of college student graduates graduate with debt. Can't believe it's only 2/3. I still have a little bit of college debt myself, as well as my wife, just a little bit anyways. So I can't believe it's only 2/3, and that student debt has reached $1.2 trillion. So really what that means is you need to start saving early and often for college. Waiting makes it much more difficult. In my example that we're going to review here in a little bit, of a 1-year-old male, and really the power of compound interest, letting your money do the work by starting early, and waiting just makes it much more difficult. And so when evaluating these different types of college funding vehicles, there's kind of 6 different characteristics you want to consider when choosing which option you're looking at. One of those characteristics, if you will, is control. Who do you want to have control of the account now and in the future? You, your child, your grandchild? That's an important consideration. And flexibility. Who can contribute and how much and for what purpose? Some savings vehicles out there let you save only for one type of specific college. If you're not exactly sure what college your 1-year-old is going to go to, which is the case for most people, there's some limited flexibility with some of those options. And taxation. Are the contributions tax deductible? tax-deferred? How will the distributions be taxed? Certainly an important consideration, of course. Financial aid. Assuming they can qualify for financial aid, will there be an impact on financial aid eligibility? Some of these options, if you have a lot of cash in them, and when a mom and dad fill out the FAFSA form for financial aid when their child's go to college, if they have a lot of assets in some of these options, you can get reduced financial aid. Life insurance typically doesn't affect that financial aid calculation. It's kind of a benefit. Growth and accumulation, what kind of time horizon are we looking at? What kind of risk do we want to take on for the sake of growth? And even estate planning. You know, some plans will not reduce your taxable estate even though you have given away the money. Others offer significant estate planning benefits. All 6 different characteristics you kind of want to consider when evaluating how to save for college. So how many of your clients have children or grandchildren? Let's say probably most of them. So again, leaving a legacy. You can insure your child at a young age, get their foot in the door and lock in that insurability. That can really be very important. We talked about that guaranteed insurability option where you can increase the death benefit $100,000 starting at age 22 and every 3 years thereafter with no additional underwriting. So you can lock in your insurability that way. Most parents transfer the ownership to their adult child once they become no longer a dependent. Maybe once they're done college, they can, continue funding it or use the cash value for whatever needs they need, whether it's paying down college, down payment on a house, other emergencies, retirement income, and it's really a way, like I've said, kind of to leave a legacy for that child. Excuse me. So now we'll get more into the case study here. This leave a legacy for $99 using our Eclipse Index Universal Life contract. So for the last 2 or 3 years, we've been #1 in the industry in accumulation-focused Index Universal Life sales, which has been a pretty fun ride, as you can imagine. And the Eclipse is our flagship product for that need. So we're going to show an example using our Eclipse product for a 1-year-old male, $99 a month with an increasing death benefit that buys over $130,000 of death benefit, showing it 100% participation in our blended index account with an assumed interest rate of 7.24. And the reason we chose 7.24%, our blended index account has a 25-year historical look-back rate of 9.24%. So we cut off 2 percentage points off of that. One could argue that's a fairly conservative rate given the historical performance of the blended index, and we have 7.24%. So what we've shown here is funding from age 1 through age 21, I believe, or through age 20, and cash withdrawal at age 22 of $23,750. That's the premium that's been paid into the policy. So mom and dad can fund it $99 a month and then really get their money back 20 years down the road from a loan from the policy. There's certainly enough cash in the policy for the child to use for other purposes like we discussed, and they can keep funding it. So it's a nice way for parents to get their money back. Grandparents also like to see that on the illustration because it kind of shows at age 22 and they can use that $23,000 and change to, say, pay down college debt or a down payment on a house or maybe wedding expenses, depending on what the need is. And so you're going to see you just fund it with $99 for 20 years. No, in my example here, there's no more additional premiums after that. We take out $23,750 at age 22, and then we just let the policy accumulate without any additional contributions, and just let the power of compound just do its thing. And you're going to see distributions starting at age 69 for 21 years. It's $57,820 each year for 21 years. That's over $1.2 million in tax-free income. Meanwhile, mom only put $23,000 and change into the policy, actually got their money back 20 years down the road, and the child still realizes $1.2 million of tax-free income in retirement. So it's pretty powerful. Here's where we really let the illustration speak for itself. Okay, so this is a Minnesota Life illustration, $99 a month, so $1,188 per year. Okay, funded for 20 years. Okay, and they got a 1-year-old preferred male. One additional differentiator that we have is we give all juveniles preferred underwriting class. The vast majority of our competitors, and virtually, I think every competitor that I'm aware of, by default, give juveniles standard underwriting. We actually give juveniles preferred underwriting, so cheaper cost of insurance. That's really going to help these things shine. So it's kind of a differentiator that we have. Give all juveniles preferred underwriting. Okay, so we have a $130,000 death benefit, and funding it for 20 years. And as you can see here, we've taken out the basis in the policy and a partial surrender for $23,750. So mom and dad can get their money back, or grandma and grandpa could see that money being used to, say, pay down existing college debt. $130,000, 7.24% rate of return. And as you can see, the death benefit and the cash value grow over time. Okay, so again, no more funding. If you can see on the previous slide, we got this $1,188 premium outlay all the way down, funded for 20 years. Take out your $23,750. No more funding. We're just going to let this thing chug along and just let the power of compound interest do its thing. And moving on to the next page, you can see here at age 69, the policy can sustain. You have $600 and some odd thousand of cash value with close to $800,000 death benefit. The policy can sustain $57,120 each and every year, all the way out. Moving on to the next page of the illustration, all the way out through age 89. So 69 through 89, that's 21 years of $57,000 income. And you can see as the net outlay, they've realized over $1.2 million of income, all by funding a measly $99 a month for 20 years if you get started early. And again, one could make the argument that 7.24%, especially given the time horizon that we're talking about with the juvenile, is a conservative interest rate. 25-year look back at 9.24%. I might also add, we're using our most conservative loan option in this illustration, our fixed unparticipating loan. If one opted for a little bit more of a aggressive loan type or variable loan option, you could potentially realize a lot more income. So we even, to some extent, use some conservative parameters here and kind of determine what this would look like. So we have a number of different types of marketing pieces. One's even approved for clients, which is pretty cool. And so you can see we've got about half a dozen of them or so here, 5. And you can certainly give us a call if you would like some of those marketing pieces, want us to put together one of these types of illustrations for you. We can talk about design and different options we can add in addition to what we talked about here today. So what I'll give you the case design team phone number. You can reach us at 888-413-7860, option 1. Once again, that's 888-413-7860, option 1. You can also email us at independentlifesales@MinnesotaLife.com. Once again, it's kind of long. It's independentlifesales@MinnesotaLife.com. So I think we've been through this as the last slide here. So maybe we'll open it up at this point and see if anybody has any questions. I think, Mark, you're in control of the mute. Is that right? Or do people typed in maybe some questions? Mark, are you there?
Yes, again. Thank you very much, Justin. Apparently the audio was only involving people who were on the phone only. So those that were fortunately on their computer with the speakers there did hear the whole presentation. And so some of you heard it twice in pieces, but I'm sure that helped settle things in a little bit deeper. Normally I would have a group of questions to ask, but I think under the circumstances, we're just going to get right down to what we have coming in. One of the first question was, on the guaranteed side of an illustration, what is Minnesota Life's current interest rate guarantee?
Yeah, so I'll kind of, it's not going to show it on the illustration here, not on the pages that we have here. So here's how the guarantee works. So all of our index accounts, they have different caps and floors, the nature of index universal life. Our blended index cap of 17%. All the floors on all the index accounts is 0. Okay. However, we do have a guaranteed interest rate of 2% that's applied at death, surrender, or lapse. So if death, surrender, or lapse occurs, and you've not realized at least 2% compounded interest up to that point, we're going to credit it with 2% compounded interest as a look back. So in any given year, if the index gets 0 or below, you can get 0. But again, if death, surrender, or lapse occurs, you get that 2% guarantee.
Okay. And do you know what the current loan interest rate is? That's a secondary question.
Yeah, so, well, we have 3 different loan types. What we've illustrated here is our most conservative loan option. It's our fixed, what they call non-participating loan option. And that's fixed, contractually not going to change, it's 4%. The other loan options, I'll briefly, our variable loan is currently 4.5. Our indexed loan is 5%. There's a number of differences, of course, aside from straight interest rate. It's outside of the scope, I think, here of this conversation. But certainly, if people had more in-depth questions, Sean, give us a call. We're happy to answer those questions.
Okay, very good. Another question came out and wanted to know that on that 1-year-old. Let me just read it the way it says. Would the 1-year-old be a MEC and taxed if withdrawals are made before a death?
No, the way this is run is it's not a modified endowment contract. So the withdrawals and the loans are not taxable.
Very good. I think another question we have, but it would be hard to do because the question basically is, how would that cash value perform during a down market as we experienced in 2008 to 2013? Yeah,
so I mean, you have the 0% floor, so you're not going to realize any investment losses that way, right? Technically, if you get a 0% rate of return, there's still some charges assessed against the contract. For juveniles, they're minimal. Cost of insurance for juveniles, next to nothing. But technically, you can go backwards a smidge to the extent there's any charges if you get 0, right? But as things rebound, the blended index has a 17% cap. You can realize up to 17% rate of return, after things rebound. One thing I will say, and I don't have the exact in front of me, but roughly speaking, in the 2000s, the S&P 500, given 2011 and everything else, or 2008 and 2001 and everything else, was roughly flat. But if you had your money in index universal life contract with that 0% floor and say a 13% cap, which our cap currently is on the S&P 500 index, you would have realized something along the lines of 8%. So that 0% floor makes a huge, huge difference. And certainly if the market's going down, 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 and there's not a lot of places to hide, but at least you can, with the index universal life contract of a 0% floor, you can protect yourself against any downside investment losses.
Okay. Very good again.
Okay.
Absolutely. Okay, we've got a question regarding business and contracting, so let me go over that for you. First of all, if you're not already contracted with Minnesota Life, please go to our Messer website, go over to the Agent Resources tab at the top, drop down to our online contracting, and then go through the process of completing that online contract for Minnesota Life. The question was, though, if she is already appointed, can she write an e-app or does she have to do a paper app? And Ms. Kelly, you could do either if you are already appointed. So that's the key thing. Get appointed so you can do either one. Second question we have coming in from Doran is, can a policy only be issued to a 1-year-old? And then he wanted to know more about the premium payment for a 13 or 18-year-old. That's going to have to be taken care of by either calling into the Minnesota desk and let them run an illustration, or the same thing, you can call in here and I can run one for you. But again, they're gracious enough to work with you on these, so there's not an overload here. And again, that number was 888-413-7860.
Yeah. Option one, the one bit I'll add to that real quickly, Mark, is that we'll insure juveniles down to, they have to be at least 14 days old. So anywhere from 2 weeks old on up, and we'll take a look at it.
Okay. Yeah. Okay, that makes sense. Good question coming in from Corey. Based on the face amount of that policy for a child, what would be Minnesota Life's requirement of coverage in effect for the parents?
Yeah, so we'd want to have ideally, so we got $130,000 of death benefit. We'd ideally like to see $260,000, twice that much, ideally on each parent. But I guess the situation really has to make sense. If one of them's a homemaker and she has only $50,000, the other one's kind of the main story, and he's got $260,000. That would be okay. So the short answer is twice as much death benefit. In other words, $260,000 on death benefit is what we want to see on the parents.
Okay, so and that's pretty common ground rule by all carriers. They want to see 2 times.
Yep, that's pretty standard. I think the logic there really is, if a family has X amount of dollars to spend on life insurance, first and foremost, it's in the kid's best interest to get the parents protected. Okay, so that's kind of the first and foremost primary objective really should be within a family. Once they're adequately insured, then we can start looking at some of these juvenile policy options.
So really, hurt you as an agent, you have to go out there and write 3 policies, maybe. Not a bad deal.
Yeah, right.
Yeah. Another question. I know there's a lot of conversion benefits with Minnesota products that we've been exposed to in the past. The question here is, though, if the client already has this whole life policy or has a whole life with Minnesota in existence, would there be a benefit for them to convert to this legacy product?
Well, you can't really convert in the traditional sense from a permanent contract to a new permanent contract. Okay, you could do like a 1035 transaction, and if it's within the same carrier, it's pretty simple. So if they have, say, and I think can you still see my screen? In year 10, we have $13,000 of cash value. You could say 1035 that if it's an existing whole life contract to a new Eclipse contract and do a 1035 transaction, and you get kind of preferred transfer of those funds from one life insurance policy to the other. It's traditionally, conversion really speaks if you have a term contract, a 20-year, $500,000 term contract, you can convert to a permanent contract. So typically, when you talk conversion, it's more in that context. But however, you can certainly do the 1035 transaction that the questioner is alluding to.
Perfect. That's exactly what they could do.
Okay,
ladies and gentlemen. Looks like we've reached the end of the questions that we have available on the screen at this time. So a couple of other things to go over with you again. Number one, please do get contracted at your first convenience with Minnesota so you'll have access to these products. Number two, make sure you have E&O because that will be required when you go through the contracting process. If you don't, again, you'll be able to use that Agent Resources tab on the Messer homepage and do your E&O right there online. And we do have the most affordable E&O for agents anywhere in the country, so take advantage of that. Also, I had mentioned in the very beginning, when you have the opportunity and have taken the time this morning to be with us, and we have you registered in attendance, if you're able to bring us a application for any Minnesota Life product here in the next 30 days, so that we can get it in the system and processed and out in the next 60 days. Messer will pay an additional $100 commission bonus to you for that new business. It's one only, so if you go out there and write 6 grandkids, that's great, but we're only going to pay the bonus on the one, okay? Again, I want to thank you, Justin, for the wonderful job you did, even under the circumstances. And I think what we learned in this particular situation was it wasn't the people that were on the computer listening to their screen, but it was those who were on a telephone line that lost that initial communication. So, again, thank you all. Yeah, have a great week, and we'll look forward to your joining us again next Wednesday, 9 o'clock Eastern Time, for another webinar with another Carrier's Products. Again, Justin, great job. Thank you very much.
Thanks for the opportunity. Make it a great day, everyone.